Stocks are the keystone of investing. It is by far the simplest and probably my favorite way to invest. A stock represents ownership of a company. So if you buy a stock in a company, you own a portion of that company. For this reason, another term to describe a stock is a share, as in, that is your share of the company. If a company has 100 shares and you own 20 of them, you effectively own 20% of that company. And if they have 50 shares and you own 20 of them, you own 40% of the company. Mega corporations you might be familiar with, like Microsoft for example, have billions of shares. So purchasing one share means you own a very small percentage of Microsoft. Stocks offer the most direct route for individuals to share in corporate success.
We gotta stick around here, buy some stock in Microsoft.
People tend to invest their money into stocks in the hopes that their investments will make them more money. Companies tend to sell ownership in their company in order to raise capital to fund business expenses. Of course, there are many ways for a company to raise capital, but selling shares of a company is the least riskiest as investors aren't guaranteed anything. Unlike with loans and bonds, where you are legally obligated to pay back the loans plus interest after some time, owners aren't guaranteed anything. So if you become an owner or a shareholder, it is very possible that your company can do poorly and you'll lose money or even go bankrupt. On the flip side, where there is higher risk, there is higher reward. Companies can perform very well and skyrocket your investments. Just take a look at Amazon. If you had invested $100 into Amazon in 1997, you would have about $20 million right now. When you invest into stocks, there are two main ways you can make money: capital appreciation and dividends. Capital appreciation is when the value of your shares increase in price. If you buy $100 worth of stock in a company and then they use that $100 to make a new product and start selling it, they will have more income in the future, so the value of your shares will go up to $120. Then, if you sell at that price, you would have made a $20 profit. One thing to keep in mind with capital appreciation is that you are only taxed on profits made when you sell. In that previous example, you would have only been taxed on the $20 profit and not the $120 you sold it for. The second way stocks make you money is through dividend payments. After a company makes revenue and pays their expenses, that leftover money is called profit. They can do whatever they want with that profit, reinvest it into the company so the company can grow faster, or they can pay some of the cash out to each shareholder as a thank you payment for owning the company stock. This payment is called dividends. Let's take a look at Pepsi during the 2023 calendar year. Pepsi made a payment of $1.15 on January 6th, then another payment of $1.15 on March 31st, then a payment of $1.26.5 in June and September. In total, they would have paid out about $4.83 per share during the calendar year of 2023. For every share of Pepsi you owned, you have made $4.83. So if you owned 100 shares, you would have made $483. There are some fundamental concepts and key terms you have to know before investing into the stock market. Firstly, stocks are known as paper assets. All that means is you don't own anything physical, but a piece of paper that signifies that you own an underlying asset. In this case, it's part of a company. Stocks being a paper asset makes them very liquid, which means it is very easy to pull your money out of or sell your shares if you need cash now. For example, a home is not very liquid. If you need to sell your home, it can take weeks or months to sell and get a hand of some cash. But with stocks, nowadays you can sell your shares at a press of a button, making stocks very liquid. Secondly, the price of a stock isn't what determines how valuable a company is. The most popular metric to determine how valuable a company is called market capitalization, or market cap. Market cap is the amount of outstanding shares there are times the amount each share is worth. So if a company has 1,000 shares worth $100 each, then the company is worth or has a market cap of $100,000. People often mistake this by assuming the stock price alone is what determines how valuable a company is. Let's take Coca-Cola and Pepsi for example. At the time of this recording, Coca-Cola shares are $67 a share, and Pepsi is about $172 a share. But does that mean Pepsi is worth more than Coke? Not necessarily. As you can see, Coke's market cap is $288 billion, which trumps Pepsi's $237 billion. So as a whole, Coke is more valuable than Pepsi, and this is because Coke has more outstanding shares than Pepsi. This concept is important to keep in mind because of the third thing we're going to discuss, which is you only make money when you sell. Your investments will always be changing in value. Nowadays, where you can buy and sell at the push of a button, it could change by a large amount in a couple of seconds. The key thing to keep in mind is that you only really make money if you sell at a profit. So imagine you buy a share at $100 and a couple months later it is at $150. If you haven't sold it yet, you have not made money yet. The price can go down to $80, and then if you sell, you would have lost $20. The price of your assets will fluctuate greatly, and if it increased without you selling it, it is called unrealized gains. You are not taxed on this, but you are only taxed on realized gains, which is the amount of profit you made when you sold it. This is key for our fourth major concept, which is taxes. Stocks offer favorable taxes as opposed to working a regular salary. Stocks don't fall under earned income like your job likely does, but instead falls under capital gains, or more specifically, long-term capital gains. As you can see from this comparison chart, if you are married and make up to $75,000 a year, you could be on the hook for 15% of your income as taxes, but with long-term capital gains, you would have to pay $0 in taxes. This long-term capital gains tax rate is advantageous for all filing status at every income level. When classifying stocks, you can classify them into two main categories: growth stock or value stock. Growth stocks belong to smaller or younger companies that have potential to return massive amounts of money in the future, while value stocks are companies that are already large and established, so they don't have the potential to grow, but they still produce healthy profits for investors, where growth stocks likely don't produce profits yet. The final core concept you should know before investing into the stock market is the relationship between risk and reward. These two things are always tied together. The riskier something is, the higher the reward, and vice versa. It may be difficult to grasp right now, but a simple example is, imagine that there are two companies that want to sell equity in their company to raise capital. Both are valuing their company at $10,000, so for every $100 you invest in it, you'll get 1% of the company. Let's say both of these companies after 5 years will be worth $1 million, so for every $100 you invested, you would have about $10,000. However, after doing an inspection of both companies, you realize Company A has employees from Ivy League universities, a plan to grow, better management, etc., while Company B has questionable management, no vision to grow, etc. You will likely want to invest in Company A, so in order to entice you to invest into Company B will likely offer you more equity. So instead of $100 giving you 1% of the company, they will give you 2%. Because Company B is riskier, they have to give you more equity. So now if they hit their $1 million valuation goal, your equity will be worth $20,000 for every $100 you invested. More risk equals more reward. In this video, we discussed all the basic things you need to know about the stock market. However, there is more to stocks than just the basics. So in the future, I will release a video going over more intermediate and more advanced concepts that you might need to know. So make sure to like, comment, subscribe, and hit the notification bell to stay notified when those videos drop.